What's up, guys? Welcome to another investing video, and in this video we're going to be talking about a fundamental concept in investing in the share market, which is the one and only PE ratio. Now, if you're watching this video, hopefully you've watched the previous videos that I've done explaining the difference or why the share market exists and how it functions, as well as some basic metrics that you can use and look at that are often quoted with any given share on the share market. Now, one of those concepts that one of those terms that you will definitely see is the PE ratio. And this is a fairly easy concept, I think, or number to understand. What isn't so easy to understand is the actual kind of core concepts behind it, okay? And this is why it definitely deserves its own video. So the PE ratio actually stands for the price to earnings ratio. And this is why this is really the core sort of concept behind the share market, because as I talked about in previous videos, when you buy shares on the share market, you're paying a price. And what do you get for that price? Well, you get a stake in the ownership of the business. Why would you want a stake in an ownership or stake of ownership in the business? So you can get the profits, so you can get the earnings. This is what we're talking about when we say earnings. We're essentially talking about the profit. Show me the money, baby, right? This is what we're talking about. So the PE ratio is simply the price divided by the earnings. Now, the price is quite simple to understand. So that is the price per share. So if you log into your brokerage account, or you just look at a website and you look at the price, you can see what it's trading at. So for argument's sake, let's just say that this particular stock is trading at $10. Okay, so you can buy it at $10 or sell it at $10. Now, the earnings is actually known as the EPS. We love acronyms in finance, don't we? So the earnings per share, okay, so the EPS. So let's just say this is, for argument's sake, 50 cents. So what this tells you is that the company makes 50 cents per share in profits. So to get that number, basically what you say is the profit for the company over the number of shares. Okay. And that's how you get your EPS. So for argument's sake, let's just say it's 50 cents. So if you say $10 over 50 cents, you get 20. Okay, so it has a PE ratio of 20. In fact, I normally don't put the X there, the times, but that's okay. So yeah, PE ratio of 20. So the question now, though, is, well, what does that actually, what really does that actually mean? Well, what it means is that for every dollar of earnings, you're paying $20. That's what it's saying. Because here we're buying a share for $10. We're paying $10 a share for a company that makes 50 cents per share. So that means we're paying $20 for every dollar of earnings. Okay? So you might have, another company that has a PE ratio of 30. And so would you rather pay $30 for a dollar of earnings, or would you rather pay $20 for a dollar of earnings? It's, a dollar of earnings is a dollar of earnings, but it's not quite, and I'll talk about that in a moment. But generally, what I'm getting at is the PE ratio tells you how expensive a stock is. So how expensive is that stock? So if you're buying a company, generally speaking, and I do say generally speaking, a low PE ratio is better. Okay, that's a tick, in case you're wondering. So you would rather pay less because you're getting the same thing. You're getting a dollar of earnings, right? Now, why this isn't quite always true is because companies that have a high PE ratio are growth stocks. Okay? And this is where we start to get into some of the limitations of a PE ratio. Because if you think about it, the price is the price of the company now, right? So if a company is, using the example above, so if a company is trading at $10 and the EPS is 50 cents, like we said, well, hang on, let's actually imagine that the EPS is going to, for argument's sake, let's say double in the next year. So it's actually going to move to $1. Now, if we use our formula of PE, so if the stock is trading at $10 and the EPS, or the earnings per share, is $1, now all of a sudden we have a PE ratio of 1, right? Because 10 divided by 1 is 1. So the company actually is becoming cheaper, which doesn't really make sense because it's actually a really good company. It's growing its profits, doubling it every year, which is actually really amazing. So what you would actually expect to balance this out is you would also expect the price to increase, right? If a company doubled its earnings, then you would expect its share price to go up. Okay? So what actually happens is people start to try and predict what the earnings are actually going to be. And this is essentially what the core concept of what the share market actually is, because the share market, and this is really critical, guys, believe me, trades on future expectations. It trades on future expectations. So if you actually, in one of the previous videos, we were looking at broker recommendations, so what brokers think the company is going to do. What they're doing is they're actually predicting this E. What are their earnings going to be? It's quite complicated. I don't really want to go, well, it's not that complicated, but essentially what they're doing is they're projecting cash flows, and then they're discounting them back to a present value. If that didn't make sense to you, don't worry, it's fine. But essentially what they're trying to guess is, well, how much money is the company going to make in, and I stress again, in the future. This is the difference between finance and accounting. Okay, accounting, it just looks at, well, what happened in the past. If you really want to be simple about it, you could say it's bookkeeping. Finance, it's all about predicting the future. And yes, they do use what's happened in the past, but ultimately it is trying to predict the future. So some companies, their earnings are going to grow and grow and grow. And in that case, they can actually trade on a high or a much higher PE ratio. So a high PE ratio can mean one of two things. Well, it could mean both. It can mean that the stock is expensive, which is actually bad. I mean, like we talked about before. Or it can mean, it can mean that it's a growth stock. In other words, it has a high PE ratio because people think that its earnings are going to grow. So you might actually have, if I go back to the example, this high growth company might only make 50 cents a year now, but it might trade at $40 for argument's sake. And so it trades on a PE of 80. There are stocks that do this, okay? There are stocks that trade on PE ratios of 80. Now, you would look at that and go, well, that's ridiculously expensive. But it can also mean that it has, because we don't, the price is tangible. We know, okay, that's what it's trading at. But the earnings is what happened in the prior year or the last 12 months. So if you see a stock with a high PE ratio, what the market is saying is, hey, we really think this company is going to grow its earnings into the future. And that is reflected in the share price now, today. And that's why I put this very key line here, which is the share market trades on future expectations. And that's why when companies release their profit results, it's not so much is it a good result or a bad result, it's how is it relative to what the market expected. If the market expected a bad result and the company reported a bad result, but it was less bad than what the market thought it was going to be, or not as worse, then the share price will go up. So to, again, just try and summarize, the PE ratio tells you how much you're paying for earnings of the company. Therefore, a lower PE ratio is better because it means it's cheaper to buy a stake in a business that's making money. However, because the share market trades on future expectations, it can also mean that the company is actually a really good company. It's growing its earnings. It's it's going to be more and more profitable in the future. Therefore, it trades at a higher PE ratio. Now, quite often the market actually overheats. So sometimes people are a little bit too optimistic, but it still gives you some indication about what sort of company it actually is. So what is a good PE ratio? Well, historically, and there have been all sorts of studies done, but the typical average PE ratio is typically around 17, 18, 19. Okay, so the market will generally trade at a PE ratio of around, as I said, 17, 18, 19. So sometimes you'll see in the media, they'll say, oh, the market is expensive. That means the market as a whole, on average, is trading on a higher PE ratio than perhaps it has historically. So it might be in the high 19s, it might be a 20. And that's what people sometimes quote in terms of, well, is the market cheap or is it expensive? You can't just look at the numbers and say, okay, well, the Dow Jones is going up or the S&P 500 is going up, while profits might also be going up. So the PE ratio gives you that sort of relative measure in terms of, well, how much are you actually paying for the earnings? It doesn't really matter what price is. It doesn't really matter what the earnings are individually. It's how they're trading at as a ratio together. Now, of course, another limitation of the PE ratio is that some companies, particularly growing companies, they may not actually be profitable. So one example of that in Australia, and this video might not age very well, but Afterpay, as of the time of this video, has still never reported a profit. Okay, I think they will very soon. They probably will in their next reporting period, but they've never actually reported a profit over a 6-month or 12-month reporting period. So their EPS is actually negative, and in that case, the PE ratio is essentially worthless. Like, it doesn't really work for negative earnings. But, it Afterpay trades, at a very high rate, again, as the time of this video, because people believe that its earnings will continue to improve, and in all likelihood it will. So I hope that made sense. If you can understand this, then I think you really have made a huge step in understanding the share market and how you can evaluate a stock. So if it didn't make sense, watch the video again or leave a comment, and I can always do perhaps another follow-up video in the future. But thanks for watching, and stick around for more great content.